wonder what I'd like to ask.
Certainly. Before I do that, Chair Lavender, I would like to remind participants, star 6 on your phone and star 7 on mute. And now call the roll. Can you hear me now?
Yeah, we can hear you now. It's a little bit, there's a little fuzziness, but we can hear you.
Governor Lujan Grisham. Treasurer Eichenberg. Present. Commissioner Garcia Richards. Secretary Romero. Tim Jennings.
Here.
Harold Lavender.
Here.
Lee Rochman.
Here.
Mike Messina.
Here.
Nick Kayas.
Here.
Catherine Allen. Here. John Bingaman. We do have a quorum, Chair Lavender.
Okay, thank you very much. I know that this is, we've switched things around a bit because of the difficulty of this month with the quorum. So we'll get into the agenda in a minute. Vince, I wonder if you would introduce your staff across the board so we know who's here. Vince, have we got you?
He is in the office, Harold, and we're going to go remind him.
Harold, Paul Chapman is on the line, and maybe the other
Hi,
asset
Paul.
director.
Okay. Have we got Vince?
We will stand by for just a moment. He'll be with us.
Oh, okay. We'll just wait patiently.
Vince is getting on right now, Harold.
Okay.
I'm here. Sorry for the delay.
That's okay. You may have done what I did and used the old access number. Anyway, Vince, welcome. And if you could run through your staff who's on the call, please.
Sure. Charlotte Bennett.
Here.
Paul Chapman.
I'm here.
Big Lee.
Here.
Mikhail Kuznetsov.
Present.
Nino Carbonito. Chris Cassidy. And who did I miss?
Clay Campbell, sir.
So Clay Camper, I heard. Oh, and Keith.
Keith Sable.
Oh, okay. All right. We're here, Harold.
Okay, great. Sounds like the staff is fully accounted for. Are there any other council members on the line besides the members of the committee and those who various committees? Is there anyone else on the line? And Steve, I know you're here. You've already spoken earlier. Good morning.
Good morning.
Okay.
Tim Jennings is here. If you didn't catch it, I don't know.
I got you. Thanks, Tim. Thanks for joining us. I know you've been on the road. Okay. Why don't we get this matter moving? Let's take a look at the approval. I need a motion to approve the agenda.
So move.
A second?
Second, Captain.
Any more discussion? All in favor? Just say aye.
Aye.
Any opposed? Any opposed? Okay, that motion carries. Let's take a look at the June 22nd, 2021 minutes. If there are no changes, I'd like to request a motion to approve those minutes.
So moved.
Catherine, thank you. A second, all right, moved and seconded. Any further discussion? Hearing none, all in favor? Aye?
Aye.
Aye. Any opposed? Okay, the minutes are approved. What we're going to do, I'm sorry?
When a motion is made or seconded, we would appreciate it if the maker or the seconder would identify themselves for the minutes.
Thank you. I appreciate that. We tend to get to rush over it sometimes. Andy, do you have the motion maker and the seconder for the motion so far?
Not the person that made the motion, please. Only the second.
Well, Tim made one on approval of the agenda.
Tim Jennings and Catherine Allen on the first one. Tim Jennings and Catherine Allen. And the second one was Catherine Allen and Tim.
Thank you.
Okay. And then we'll just be sure to do that from now on. I think I may have printed out the incorrect agenda. Let me get mine open here real quickly. I know we had a change. I believe, if I'm not mistaken, we're going to move right immediately into the motions and the voting items so that we have a quorum and continue to keep the quorum. That would move us down to the number 3. We'll do number 3 first, if I'm not mistaken. And then I apologize, I'm babbling a little bit. Let me get my correct.
Harold, this is Steve. Let me explain to everyone why we have been going back and forth with different agenda priorities. It's been very difficult today to determine whether or not we were going to have a quorum. And in order to facilitate the ability to vote, we've been making these changes. So we apologize for the multiple emails we have sent you. We are so pleased that we have even more than a quorum. And Harold, we are now moving to the new market vote and presentation.
Okay. Well, if we can take off there, I believe that'll be Vince. You want to take it away?
Hi, Harold.
Yeah.
It's Keith Sable. I'll just.
Great. Go ahead, Keith.
Please go ahead. All right. Great. So Keith Sable, Fixed Income Director. We're recommending that SIC commit up to $150 million to the New Market International Infrastructure Finance Fund number 3. The home for these assets would be in the distressed and other category. The general partner, New Market Capital, is headquartered in Philadelphia, Pennsylvania, and was founded by CEO Andrew Holmes. The firm currently manages in excess of $1 billion, and the strategy targets IRRs in the 8 to 10% range, most of that return being delivered as income. In building out the private credit portfolio, staff is seeking diversifying strategies that present unique opportunities to monetize the liquidity and complexity premium that typically motivates investment in the private asset classes. New Market's credit risk transfer strategy is a new class of investments for the portfolio. A credit risk transfer is a highly structured transaction in which one party agrees to protect another from credit risk embedded in its loan portfolio in return for a periodic coupon payment. New Market sources transactions with major global banks, providing credit protection to diverse portfolios of secured senior loans backed primarily by seasoned infrastructure projects. The staff recommendation memo is on page 292 of the diligent board book, just for reference purposes. I think since this is a new investment, though, I'll just jump in with a couple of quick summary comments before I hand off to Trevor Jackson of the Axia team, who will present their due diligence, and then we'll follow up Trevor with founding partner Molly Whitehouse and managing director Steve Ezzy from New Market. The way to think about this strategy, or the most similar strategy already in the SIC's book of investments, would be an infrastructure debt strategy, an infrastructure debt fund. It's most similar because the underlying assets are pretty much the same. We're looking at performing secured, seasoned investments in largely critical infrastructure assets. Another reason for liking the strategy is that it's a unique source of this complexity and illiquidity premium that we typically seek in the private credit markets. The deals that New Market sources with the banks tend to be bilateral agreements that are highly structured and highly negotiated, and they create a lot of value for the banks. And that value add for the banks is ultimately the source of this premium that the New Market is able to capture. One of the things that we also find compelling about the strategy is a degree of diversity in the underlying book. A typical deal with a bank would include somewhere between 100, 150 underlying loans, and there would be about roughly 8 of these deals in a typical portfolio. So the fully funded strategy would have a diverse portfolio of around a ballpark of 1,000 assets. These are broadly diversified across geography and industries and asset types, and so it tremendously reduces the risk posed by any individual asset or individual risk factor. A final point that I'd like to raise is that while infrastructure investing typically has a green or an ESG component, New Market has been recognized for the innovative approaches that it takes to directing capital toward environmentally, socially friendly projects. That's the very high-level summary of the investment. At this point, I would turn over to Trevor for the AXIA team's underwriting of the New Market Iafc portfolio strategy, and then Trevor, if you would just hand off to Steve and Molly when your team is complete. Thank you.
Okay. Thank you, Keith, and good morning to everyone of the council. My name is Trevor Jackson. I'm a member of the AXIA team. I'm going to give some comments and actually include my colleague Tom Bernhardt and our research team to give a couple comments as well. As Keith mentioned, New Market's a specialty finance manager. It's a category that's new to you all in the regulatory capital relief space. We view them as a leader in kind of what they do in that experiencing sourcing of investments and infrastructure-related portfolios. They've been doing a long period of time, and they're a good team that do it. It's a differentiated strategy that really kind of complements what's in your current portfolio. It fits into your distressed/other category, and really kind of the other side of that category. In your non-core fixed income bucket, you have ranges for public markets, structured credit, lending strategies, and distressed/other. And they range for each of these categories between 20 and 40%. And so on a net asset value basis, your public markets and structured credit are about midpoint of that target range. You did distress and other in the midpoint of that range as well, with money you put to work earlier this year with strategic value, special situations, and now New Market. So we think it fits really nicely, and we're going to continue to help Keith and the team build out over time. But I'll pause there, and I'll turn it over to Tom to kind of give some comments about the manager before we turn over to the manager themselves. Tom?
Sure. Hello, Tom Bernhardt. I'm part of the AXIA research group. Yes, I've been following New Market since before they became New Market some years ago, since about 2013 or 14, when they raised Fund 1. And over the years, they've been able to demonstrate the strategy. I think the key issues or the key merits that we find for this strategy are, as has been mentioned before, it's differentiated within the risk transfer space, reg cap space. New Market is pretty much the clear leader in this type of infrastructure-related asset risk transfer space, and the performance has been good. Fund 1 is trending over a 7% net IRR, and Fund 2 close to a 9% net IRR, which is very much in line with what our expectations were and have been. I would say that the regulatory environment, or just the market environment in general, is very conducive to this strategy. Risk transfer transactions have been gaining ground substantially over the last several years, and the regulatory environment has been really just nothing but tighter since the global financial crisis. So that means that there's a substantial pipeline of attractive opportunities for new market to pursue. I would say that the main risks here are obviously the structural risk related to the transactions themselves, because new market's position is subordinate to the first lien debt within these structures, and then the possibility of some sort of credit disruption is always an issue with this type of strategy. I would comment that the credit environment has been very relatively benign over the last several years. So with that, I would say that that's kind of the pros and cons of what we see.
So this is Kathy. I have a question about their cybersecurity practices and what kind of security measures do they have? Because again, they're vulnerable to be hacked. So what do we know about that? Can you hear me?
Yeah.
Yeah, we
can hear you.
I'm sorry.
Yeah. No, I'm here. So yeah, as part of our diligence, we did an entire operating due diligence review of the firm, and that included cybersecurity. The team's assessment was that New Market's processes were more than adequate with regard to cybersecurity.
Okay. And can you give me an example when you do due diligence? Who has the expertise and what kind of questions do you ask around the cybersecurity practices?
Yeah, that's our operational due diligence team. They tend to ask about what systems are in place, what procedures are in place. They talk to the key people who manage that process, and then they compare that based on their experience with what they've seen at other firms. There's an entire questionnaire that's involved with that, and then also a site visit, or these days a virtual site visit. But they would the questions would focus on those areas.
Okay. Is it possible to see those questions? The reason I'm asking, my business is cyber. I have a membership organization of large corporations, mostly large financials, in third-party risk and cybersecurity, and there's kind of a set list. There's sort of a set of protocol questions that financial institutions, if financial institutions will look at and assess this company in terms of any kind of trade transactions. So my question there is, how diligent is it, and are they meeting the NIST protocols?
I can't really speak to that directly. I would say that to your earlier question about whether you could see that material, I'm sure that there's no problem with that.
Okay. That would be, yeah. And then I can compare it to what most large banks are requiring in a assessment for third parties, and that might give your team some better ideas of what questions asked, or you may be already asking them. But it is a growing concern, as you know, because of ransomware and the larger number of hacks.
Right. I think, go ahead.
This is Trevor. We appreciate that. We spend a lot of time in our due diligence asking a number of questions, so we'd be happy to see some of the questions that you have and share with our team.
Okay, that'd be great.
So Trevor, if your team is, I guess, are there further questions for the Axia team? And if not, perhaps we could move on to the New Market representatives to address the topics they wanted to cover in their management presentation, and then perhaps they could circle back on the cybersecurity question.
That'd be fine.
Great, thank you.
Can you hear me, Keith?
I can. Go ahead, Steve.
Great. Hi, I'm Steve Ezzies. Before I start, Steve and Vince, it's nice to hear your voice. It's been a long time, and wish this could have been in person. It's I'm looking forward to the opportunities to come back to New Mexico. It's been way too long.
Steve, it's good to hear from you. I believe it's been about 9 years.
And who's counting?
Not I.
Yeah, me either, for that matter. So for everyone else, I'm Steve Ezzies, and I'm joined by Molly Whitehouse. Molly is one of the founders of New Market, and Molly is the portfolio manager for the Iafc Strategy. We plan to review for everyone the strategy, our investment process, the opportunities we see going forward, and we'd like to talk about the Cheetah transaction, which is in the presentation, which is an example of an investment which successfully combined excellent returns with ESG and impact outcomes. And as Keith has noted, we've received recognition for our innovative ESG and impact structures for a number of the New Market transactions. The Iafc strategy is to generate non-correlated, non-volatile current income through investments in bank-owned portfolios of seasoned, senior secured infrastructure bank debt. We've successfully achieved this by providing long-term capital relief and capital management solutions to global financial institutions. The Iafc strategy focuses on infrastructure as an asset class due to its historical track record of low defaults, high recoveries, and low correlation to other major markets. As Tom pointed out, coupons have ranged in the low teens with net returns in the high single digits, with income typically paid quarterly as a spread over a base rate. The Iafc strategy does not rely on portfolio leverage or the use of derivatives to enhance returns. In a moment, Molly will go into greater detail on the strategy. As you'll see in the deck, over the last 8 years, we've completed over $20 billion of transactions with leading infrastructure banks globally. Of these, they include Citibank, Societe Generale, Credit Agricole, and Santander. 11 of our 17 professionals are members of the New Market investment team, and they all have extensive infrastructure credit expertise. And I just want to leave you with this thought before I turn this over to Molly. We have successfully navigated this challenging COVID environment, and we now have the opportunity with Iafc 3 to construct infrastructure portfolios, having the insight on how these projects have performed over the last couple of these clearly difficult years. Molly, can you introduce yourself, please?
Thank you so much, Keith. My name is Molly Whitehouse, and I've been with the Isp Strategy since we founded it. So nearly 8 years now, and as Steve mentioned, well over 20 billion of underwriting track record. The Isp Strategy provides credit protection to banks on selected portfolios of seasoned assets, which are held on the bank's balance sheet, as described a bit more on slide 4. This credit protection is valuable to the bank because they're subject to certain rules that require them to hold significant capital against these loans. But when our funds absorb the credit exposure, then the bank has to hold substantially less capital. This enables the bank to do more lending in their core portfolios while optimizing their return on equity and maintaining their largest key borrower relationship. Meanwhile, for our limited partners, they're able to take exposure to seasoned portfolios of selected senior infrastructure debt achieving what we believe to be very attractive risk-adjusted returns, and as Steve mentioned, regular cash flows. All of the cash flows are distributed to limited partners as they are received. Within this broader risk transfer market, the Ifc strategy has focused largely on infrastructure, because as Steve mentioned, and as detailed more on slide 12, you can see that infrastructure has been a very steady asset class over a long period of time, with a cumulative 10-year default rate, so over 10 years, of only 5.7%, and average recoveries of about 80%. Additionally, the default risk tapers off after the construction period and is lower in the operational stage, which is where we've taken the bulk of our historical exposure. It's worth noting that Ifc and the Ifc investments have typically taken exposure to the senior position of that senior loan at the asset level. This means for one of these loans in our investments, the equity and the mezzanine debt for that project would need to be totally wiped out before our investment would structure any losses. So at the asset level, we have significant protection. To turn to a specific example of something that the Ifc strategy has invested in, I'd invite you to please turn to slide 18, where we describe the so-called Cheetah Investments. It's a little bit of a funny pronunciation, but it's based on city and then affordable housing. And here we provided capital in exchange for periodic income on a nearly $1 billion portfolio of U.S. affordable housing loans. This investment tracks a lot of the attributes that we target within our investments. For one, we target the core lending areas of the bank where they have a robust lending track record and deep expertise. As of the underwriting, City Affordable Housing Platform had a delinquency rate of just 0.09% and zero historical losses across an underwriting track record of nearly $27 billion. Two, within these core platforms, our credit team specifically selects portfolios on an asset-by-asset basis, focusing on loans with strong credit fundamentals. So for Cheetah, we ultimately selected 96 assets based on low LTVs and high occupancy rates to include in the portfolio. Kathy, I know that you commented about cybersecurity, and I am not the person on the team who is the expert here, but I can tell you that we receive a lot of detailed internal information from our bank counterparties on both a loan level and on the bank's internal processes. And so it's extremely important to us that we have robust internal cybersecurity procedures because there's quite sensitive information that we review in our investment diligence. Finally, I would comment that we're always focused on strong investment features and what we believe deliver very attractive risk-adjusted returns. The Cheetah investment also is a nice example of our investment track record because it builds on Ifc track record in ESG and an impact, including one of several awards, which was the Environmental Finance ESG Innovation of the Year. So with that, I just want to thank you very much to everyone, Trevor and Tom, for the introduction, and to Steve. And if there are any questions, we're happy to answer them.
Are there any questions or any follow-up questions? This investment was looked at very closely at the investment committee meeting, and the group, we unanimously agreed that we would move this and move it forward and recommend it. If it's okay, I'll move back and forth between my role as chairman of the investment committee and the temporary chair today. I will move, based on the recommendation of the Council Investment Committee, non-core fixed income advisor AXIA SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $150 million in New Market International Infrastructure Finance Company Fund 3, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork. Is there a second?
I second.
Okay, I think I heard Kathy first, so Kathy Allen seconds. Are there any further questions or discussion about this particular investment? Hearing none, all in favor, please. I'm sorry?
Yeah, this is Lee, Harold. I would just like a copy of those same questions that to which Kathy was referring later on.
Hearing no other questions, all in favor, please say aye.
No,
Aye.
Harold, we want to do a roll call. Let's do a roll call.
Oh, okay. Thank you very much. I appreciate that. That's
On
right. We do
substantive
have to do
issues,
that.
I think we want a roll call.
Okay, thank you. Andy, if you please call the roll.
Certainly. Governor Lujan Grisham. Lujan Grisham. Commissioner Garcia Richards. Secretary Romero. Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Jennings.
Yes.
Mr. Messina.
Yes.
Mr. Tejas.
Yes.
Fallon.
Yes.
Mr. Bingaman.
Yes.
The vote is 8-3, and motion carried.
Thank you, Andy, and thank you, everyone. John, welcome. We know you, when we called the roll, you weren't here, but you are now, and I know you have to catch a flight, so thanks for joining us. With that approval, we will move on. I apologize for, yes, sir.
Chair?
Go ahead.
This is Tim.
Yes.
And I just want to correct Andy. It would have passed 8-0 with 3 non-voting members not present, not 8-3.
Thank you.
Thank you very much, Tim. I couldn't hear that part of what she said. So thank you for correcting that. I appreciate I apologize for the little bit of confusion on my part. I did have the wrong agenda, but I think we're back in good shape now so we can move forward. Let's move to the Jamestown. Yes, go ahead.
Chair, this is, and I just want to let Andy know that she's going to be a welcome member of the team, but she's going to have to get used to all of us as we get used to her. and we're difficult. So
yeah, that's right.
Andy's got to work that out for us.
You got it, and some more difficult than others. Anyway, Andy, if you got all that. That's great. Thank you, Tim. Yeah. Yes, Mike.
Don't be naming names now.
That's why I said some. Anyway, we can move on from there. Thank you very much, and I appreciate that, Tim. Yeah, Andy, you'll get used to all of this. Each of us has our own predilections. Let's move on to the Jamestown Premier Property Fund, and that's Paul Chapman.
Thank you very much, Chairman Lavender. Townsend's memo supporting the full redemption request on the Jamestown Premier Property Fund begins on page 346. This is from the revised PDF that council members received yesterday from Andy. And for the other items that I have on the investment committee agenda today, I'll be kind of referring to that document as opposed to diligence. I hope that's not inconvenient for anybody. As you'll see when we get to the structure study later on, staff recommends that we continue to underweight office and retail in our real estate portfolio. This has really been fundamental to our portfolio's outperformance relative to our benchmark. The Jamestown Premier Property Fund is 92% allocated to those two sectors, and accordingly, we don't think it's a good fit for our portfolio. And as much as Jamestown may want to reduce exposure to these sectors, it will just be very difficult to accomplish given the lack of investor demand for office and retail assets. The other way that GPs reshape their portfolio is raising new capital. But it's also difficult for Jamestown to do this right now because when LPs see the concentration of those two sectors, they generally drop the conversation. So we just think that it's appropriate for our portfolio to put a full redemption request in here. And with that, I'll just pass it over to you.
Thanks, Paul. And I'll be brief today. We had a partial redemption previously approved for this commitment. I think it was back in last year, September of 2020, and that was for $50 million. We're moving forward and recommending a full redemption today for the reasons Paul mentioned. Part of this investment, this is one of the first investments we made as the SIC and your staff and your consultants were brought in 2011. And this investment has performed well. I think that's important to point out. The investment's delivered an 8.8% net return, a 1.5 equity multiple to current value. But to Paul's point, looking forward, being highly allocated to retail and office is not ideal in the current environment, and we think there's a little bit of risk there. So we're looking to redeem. Importantly, we don't anticipate receiving the redemption capital, the redeemed capital immediately. This will take time as Jamestown looks to either sell assets or raise new capital. But beyond that, we are still recommending to redeem today. And I'll leave it at that and happy to answer any questions.
Are there any questions for Paul or for Seth? Again, this was reviewed at the investment committee meeting and we recommend approval. If there are no questions, based on the recommendation of the council investment committee. Go ahead, Lee.
I'm sorry, this is Lee. I'm just curious as to where this initiated. If it initiated with Seth or our staff, or where it initiated.
I would say we both came at it from sort of different directions. Townsend regularly tracks all of the funds that the major funds that are out there, and I can let Seth speak to that. But we also look at our portfolio constantly to see if there's places where we think our capital can be better deployed. And it's unfortunate that we're having this conversation in advance of the structure study discussion, because the structure study really lays out the reasons why staff and also Townsend are negative on retail and office. But anyone who's picked up the front page of a newspaper lately knows that the office sector is under a lot of stress, and the retail sector is under even more stress. So, we just, we look at our portfolio and think about ways to move the portfolio in the direction that we're recommending in the structure study.
Okay, thank you. And Harold, I apologize. I keep it on mute, and then it just takes a while to get it going again.
You got it, Lee. I appreciate that. You know what? I'm going to be I will hesitate a moment longer because I do the same thing myself. So thank you. Okay. Based on the recommendations of the Council Investment Committee, Real Estate Advisor of the Townsend Group, SIC staff in general, fiduciary oversight of RBK, I move that the State Investment Council approve the full redemption of the SIC's investment in Jamestown Premier Property Fund, as reviewed, discussed, and memorialized by the Council today. Is there a second?
Second, Nick.
Thank you, Nick. Motion moved and seconded that we liquidate Jamestown. Is there any further discussion? Andy, if you'll call the roll, please.
Certainly. Governor
And my suggestion, unless is that just call the roll of those who are here. It might be simpler.
Treasurer Eichenberg?
Yes.
Mr. Lavender?
Yes.
Mr. Rawson?
Yes.
Mr. Jennings?
Yes.
Mr.
Yes.
Messina? Mr. Messina?
Yes.
Mr. Tejas?
Yes.
Ms. Allen?
Yes.
Do we have Mr. Bingaman?
Yes.
Eight votes. Motion carries.
Well, they have lost. I counted 8-0. Is that
Yes.
what you got?
Uh-huh.
Okay, 8 in favor. All right, that motion passes. Thank you very much. Let's move right along to Brent and the fiscal year 23 appropriation request. Brent?
Yes, Harold, I'm here, and I'll hopefully be quick in my comments. I'm on page 401 of the diligent materials, Just a couple of things to mention that I think is important, and I like to reemphasize as we have new council members. The appropriation request for the items that actually flow through our budget is funded by the Land Grant Permanent Fund and the Severance Tax Permanent Fund, and that funding from them is offset by client fees. So it's kind of a net number. This appropriation request for fiscal year 23, as everybody might know, we're 22 months from the end of fiscal year 23. So there is a vast amount of estimating that goes on, especially as it relates to management fees. During the audit committee meeting yesterday, we got some questions, and I wanted to reemphasize when we're talking appropriation request and fees that go through our budget, we're primarily talking about fees related to equity and bonds, et cetera, the public markets. The private markets, private equity, real estate, real assets, et cetera, does not go through the appropriation request process. Those fees, whether it be fees or carried interest, is actually deducted from the investment value. So the flow of those monies are a little bit different. I did want to point out, as I went back and looked at the appropriation request for fiscal year 22, fiscal year 22 is the fiscal year that we just started. We're in August of that fiscal year. Last year when we did the appropriation request, I think the overall comparison to the prior year was about 4.3% decline. If I had to do that request again today and recall that we're doing it well in advance, I probably would request a 4% increase for fiscal year 22, because it's very likely as we get into fiscal year 22, the year that we're in, that we're going to have to do a bar. And you might say, well, why are you going to have to do a bar? Recall in fiscal year 21, the fiscal year that we just ended in June, the Land Grant Permanent Fund returned over 25%. Because of the increase in the market values of those public assets, the fees have increased, and because they've increased, and it's related to the increase in the value of those assets, we see that continuing. The appropriation request that you have before you for fiscal year 23, the majority of the increase, and we're at over 15%, relates to fees within that middle section, which is the 300s. It's all related to fees for the most part. The 200s, which is the payroll part of the appropriation request, shows a little bit of a decline. Recall that our positions that are authorized were cut in fiscal year 22 from 31 to 26. Many of those positions that we lost weren't funded, so it's not as big of an issue, and if we need to add those positions back, we can. Other than that, I would just say for the category 400, we're showing a little bit of an increase. I'm at a little bit of a disadvantage on some of these expenses as we're forecasting, because fiscal year 21, because of COVID, we didn't have travel, things were not as normal as they are. Fiscal year 22, we're not going to have travel and some other things. So estimating into fiscal year 23 is a little bit of a challenge. I did some very small increases in that last category. And as I said before, the overall increase in the appropriation request is about 15%. Now, I've received some questions from others, and I've thought about it a little bit, and I think we're probably not the only investing agency, whether it be PARA or ERB. They had pretty good returns last year as well. I would think that their appropriation request for fiscal year 23, it might not be at 15%, but it's certainly not going to be a flat request. So I feel very comfortable going in based upon my fee tester analysis that I do, and I've attached that. It's a little small, but I'm probably, based upon the standard normal bell curve, 95% certain based upon the fees that I've estimated for fiscal year 23 that we'll have enough fees for that fiscal year, based upon the 15% increase to get us through everything that we could potentially bear as far as the market is concerned. Bear in mind, when I'm doing these appropriation requests, I'm always planning and managing to make sure that we have enough budget. And that's my number one desire, is to make it through the fiscal year without having to do a bar. So I'm open to any questions anybody might have.
Brent, I actually have one. When we approved this so early, so far in advance of the year, do we revise this, or do you come back to us with changes? Please remind me of what happens relative to these numbers.
Yeah, that's a really good question, Harold, and I'll emphasize a couple of things. We're still September 1st is the filing deadline for this appropriation request, so there might be some small refinements. The things that we're challenged with this year is primarily a new appropriation or a budgeting system that DFA implemented, which we're working through challenges as you have with new systems. But Harold, the appropriation request will go to the legislature. The executive makes her recommendation, LFC makes their recommendation, and usually the lower of those two recommendations are selected. Usually as it relates to fees, they haven't really pushed back on fees. They've always made sure that we have enough in our request for fees, so I'm not too concerned about that. But after it's approved by the legislature, we do have language within the appropriation statute to do a bar if we need. So, and we haven't typically had to do a budget adjustment request where we're requesting additional budgets. I don't think we've done any in the last 8 or 9 years. Pardon me?
I'm sorry. Excuse me a second, Brent. Could everybody make sure you're muted when someone else is speaking? Thanks.
Yeah. So Harold, to your question, we do have a mechanism to request additional money should we need it. But these numbers, pretty much once we get a recommendation from either the executive and the LFC, and the lower of those recommendations are selected, those numbers will be the numbers that we use for fiscal year 23. We are allowed to do some reallocating within categories, but you really can't reallocate across budget categories without approval. So the numbers are what they are. That's why we always make sure that we have enough money as the request goes, and that we have additional bar language should we need additional monies to cover management fees. As I emphasized earlier, it's better than likely this year that, and that's fiscal year 22, we'll have to do a bar because it's very likely we're going to probably get to the end of the fiscal year that we're in and not have enough monies to cover management fees. And that's just a reflection of the run-up in the market that we had through the end of the last fiscal year. And hopefully that answers your question, Harold. If not, I'm happy to elaborate more.
It does. Nick, would you like to make this motion, please?
Yeah. Do I have to read specifically?
Yeah. Yeah, you read the whole thing.
Okay, where is it at? Here.
It's on the second page.
appropriation. Okay, I moved based on the recommendation of the Council Audit Committee and SIC staff, that we approve the Council's fiscal year 2023 appropriation request, as discussed by Brent.
This is Lane.
Okay, is there a second? Okay, I'm sorry, who seconded?
Kathy, I'll second it.
Okay, moved and seconded. Are there any further discussions about this? Hearing none, would you call the roll, please, Andy?
Certainly. Has Secretary Romero joined the call? Okay. Governor Lujan Grisham. Oh, I'm sorry. Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Jennings.
Yes.
Mr. Messina.
Yes.
Mr. Taya.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Motion carries 8 votes to 0.
Thank you very much, and thank you, Council. That's it. Yes, Tim?
Mr. Chair, this is Tim. Did we, and I'm sorry, I'm not looking at the right agenda, but are we skipping over 3F, which is the ESG policy?
No, that comes later. You're having the same problem I did at the beginning. There's a one-page agenda change that has marked in yellow. We will be covering that, Jim.
Okay, thank you, Mr. Chair.
Thank you. Moving along, Vince, why don't you take us through the 2022 annual investment plan?
Well, thanks, Mr. Chairman. Dave Jackson, our top shelf tech guru, has my phone back up and running. Am I coming through clearly?
Yes, you are. I can hear you. I hope everyone else can too.
All right. Okay. Well, I'm very pleased to deliver this year's annual investment plan. This is the 10th time I've had the privilege to do so. As you know, this is a forward-looking document capturing the thinking and direction of the Council, the Investment Committee, the Investment Office, and Investment Team, as well as our investment consultants. Changes to the format this year include the addition of an executive summary, which I managed to squeeze in on the bottom quarter of the first page. So it's quite a tight summary. I guess I would start by just saying that saying the obvious, which is the last 18 months have been quite a ride for the global economy and the financial markets. The pandemic-related shutdowns plunged the global economy into one of the steepest but short-lived recessions ever suffered. Most economies aren't quite back to their old peak output, but we're definitely getting closer, and growth rates right now are quite high across the world. The enormous financial response by governments and global central banks to manage the downturn had the predictable results. It got us back on track economically, and as you've been tracking some of the numbers, you can see that the U.S. economy is growing between 5% and 6%, which is more than double our long run rate that we expect, and we'll get into that in a minute. But it's also had the results of public debt having just exploded in size, global central banks' balance sheets ballooning, and then the increase to money supply around the world, particularly relative to available goods and services, has expanded tremendously. So while this activity has put the economy back on track, it has pumped up the financial markets to new highs in valuations, and it is spilling over into both consumer and producer price inflation. So sort of an interesting position. I think I said on the investment committee call, I'm now convinced as much as ever that we live in interesting times in terms of the curse. Lots of things happening, lots of things going many different directions. Just quickly on implications, I mentioned that most economies around the world are growing well above average right now, but at least here in the United States, we're expecting to return to the 1.5 to 2.5 growth rate here just in the next few quarters. There's still some stimulus plans being discussed in the U.S. Congress, a $1.5 trillion bill and then a $3.5 trillion bill, both for combined $5 trillion worth of spending. that could extend high growth rates here in the United States for a few more quarters. But ultimately, we think we come back down to that 1.5 and as high as 2.5 growth rate here, particularly here in the United States. Inflation, we mentioned, is running high. There's a little bit or growing concern over the stickiness of that price level rate of increase. So we're up in the 5s now, and as detailed in the plan, our economy doesn't withstand rates of inflation much above 5% without falling markets and other difficulties. So we're keeping our eye on it. We can take short bursts. If we look back in history, we can see where we've taken short burst economy into recession and big corrections in stocks and other risk assets. So keeping our eye there on inflation. Interest rates we expect to be on the rise, not in the not too distant future. In fact, the global central banks and other financial folks from around the world meet annually in Jackson Hole, Wyoming. That's coming up here shortly, and we'll have a lot more news tends to come out of that meeting, in particular on interest rates. So we've got our eyes and ears open on that. Just a couple of notes on what the effect we think over the annual investment plan period, the 7 to 10 year period, would be, and that is we think growth will come back down and stay 2.5% will be a good rate. We think we'll be happy to see that rate. I think over the period, more likely we're going to see 2% or less here in the United States. It's really a function of demographics. We're still in that saddle that we've talked about before, where the baby boomers are retiring. But the millennials aren't quite yet to their peak earnings years. In fact, the very front edge of the millennials are finally hitting that 45 to 55-year-old category, where people tend to earn their highest lifetime earnings, per year. Just the very front edge of the millennials are starting to get there. So we still have another 7 to 10 years before the millennials, which is a generation that we expect to be bigger than the boomers at the boomers' peak. Before the middle of that generation is in their peak earnings years. We think the economy will really pick up then. That's the light at the end of the tunnel. The other side of growth, in addition to the size of the labor force, which is driven by the size of the population, of course, is the advancement in technology and productivity more broadly. That we're expecting some increase in that because it's been lower in the last 10 years than average, and it tends to be a little bit cyclical. So we see it, high and then sort of dropping down a little bit lower. We think we might be moving into a period where we get a little more productivity growth, so that could hold us up. If it doesn't, we're probably below 2% on GDP growth over the period. Interest rates we definitely expect will continue to increase. The Fed's been talking about increasing short-term interest rates, maybe 6 to 8 quarters out. That's where they produce something called the dot chart, which shows where each of the Fed governors think the direction of interest rates should go. That's indicating 6 to 8 quarters out before we'll see increases in the short-term rates. We think we'll see increases in longer-term rates ahead of that, partially due to the inflation and partially due to increased demand for capital, as the economy continues to grow. And then lastly, I guess we talked about inflation a little bit already. We think that'll probably run a little higher over the period than it did in the last 10 years. So an okay environment for us, I think, from an economic standpoint. Obviously in any 7 to 10 year period, we can see a recession. But I think that'll be a function of what it traditionally has been, and that's when the Fed starts raising interest rates in response to inflation. So I think we'll have some normal activity from that respect. Financial markets implications. We just did an asset allocation study for land grant severance tax funds. You saw RBK's capital market assumptions, and they're about as low as we've seen them. Particularly for U.S. stocks, a little bit better for foreign stocks in U.S. dollar return expectations. Very low, of course, from core bonds. Interest rates are just so low right now, and all assets, all risk assets, have lower expected rates of return. Just about since we've been bringing you asset class or asset allocation studies. So the main reason there is markets have just been pumped up with all the stimulus that we've had put into the system to try to get the economy back on track. And we're just at high valuations. High valuations almost always, at some point in the longer term, the sort of the 7 to 10 year time frame, almost always imply lower rates of return from our assets, and that's just where we're at. And you heard us talk about the low return environment for quite some time. That really did play out from 2007, when the market peaked, through about 2016. But we've had pretty good returns, slightly above average, since 2016. We would expect that to turn back down to below average returns over this forward 7 to 10 year period. So with that, the broad changes to the broad investment strategy, I always put the previous year's strategy in, and then the current year's strategy, so it's easy to compare. That's on pages 4 and 5 of the annual investment plan. Not a great deal of change. We think we came through a recession, a very quick early cycle recovery. We're probably moving into mid-cycle now as things start to stabilize, particularly as when we see GDP growth starting to return to that 2.5% area. That would definitely give us a good signal that we're back in the mid-cycle. So we're not at a whole different place than we were just a couple of years ago when we delivered the annual investment plan. So not a great deal of change in our strategy. We continue to be cautious of the U.S. equity market and risk assets in general, and that's just straight up on a valuation reasoning. And as we move forward, certainly the Fed liquidity is going to fall, and interest rates start to rise. Both those things are supportive, or not supportive of financial markets as much as increased liquidity and falling interest rates. We still think that liquidity and flexibility within the portfolio remains important. We saw from last spring certainly just how quickly things can fall apart on us, and having the liquidity that we did was the correct move. We still think that still plays out over this 7 to 10 year period. The low interest rates has put a premium, continues to put a premium on income production. So assets that produce little or no income are at much higher price risk, or much higher risk of price volatility, than assets which produce significant income as a percentage of their total rate of return. So we continue to concentrate on finding those assets which have good rates of return, but also throw off some income. And we've been successful with that. The portfolio is really generating a lot of income, and as such, just doesn't show the volatility that many other portfolios do. We're trying to reduce our core fixed income assets when we can find opportunities to do so. We're still a little bit overweight core fixed in the portfolio, but slowly getting that out the door into things like real estate and our real return portfolio, and to a degree our private equity portfolio. So not a great deal of change this year from last year's direction and plans, and it's really just a function that we're not at a whole different place in future expected economic performance than we are, but we are in a different place in terms of valuations, and it's not in our favor. They're higher. So we think the basic strategy we've been employing is still is correct. Part 2 of the report is always the outlook for the land grant and severance tax permanent funds. We've got the figures in there just based on our intergenerational equity model that we've developed with RBK. We would look to see the land grant grow about $6.4 or $6.5 billion over that 7 to 10 year horizon, which would be an increase of about 2.6% in fund size annually over that period. We think that distributions could grow a little faster than that. Not entirely a lot, because those two things are very linked. But we could see between 2.5% and 3% growth in distributions we would expect. Severance tax, not quite as good a picture. We're looking at annualized growth there of about 1.4% per year. That's roughly $700 million in the portfolio total. Distributions there are just about the same, between 1.5% and 1.5% increases in distributions annually is what the model's trying to tell us here. The last part of the plan, as you know, is the asset class plans. We've got detailed plans in there for each of our major asset classes over that 7 to 10 year time frame. I won't detail those to you and just leave those open to any on this plan, but we're available for any discussion or questions that the council might have.
Thank you, Vince. Any questions for Vince?
Mr. Chairman?
Yes, sir.
Yes, I'm sorry, but I have to excuse myself from the remainder of the meeting. I have a conflict.
Okay, Mike. Thank you.
Okay, thank you.
Are there any questions for Vince about the plan?
Mr. Chairman, John Bingaman here.
Yes, John.
Yeah, Vince, thanks for that presentation. And just wanted to ask your thoughts about emerging markets. I've been hearing some commentators basically say that's like the one area that's what we don't often talk about things in terms of emerging markets, developed markets. Could you talk a little bit about that, what posture is, and whether there may be some opportunities to emphasize that maybe a bit more going forward?
Sure, John. So we're roughly equal weight to the benchmark with the we've got good exposure there. One issue we're discussing now and sort of working our way through is the increased and continuingly increased allocation to China in the emerging markets index. China's going to be, when it's fully in the index, it will be a very large portion of that index over. We're discussing how quite to handle and how quite to approach that issue. Generally, I think if we get the inflation that we're expecting, if inflation is a little on the higher end as opposed to the lower end, emerging markets tend to do pretty well out of there because they tend to be natural resource producers, right? So we would expect the companies in some of these EM countries to do a little bit better if there's particular price inflation in raw materials. Without that, generally those and that we don't expect. So I kind of hate to be the two-handed, but there are two sides to that story. To answer your question directly, is we're about equal weight against our benchmark. So no particular exposure there, but exposed as much as the benchmark would guide us.
Okay, thanks for that.
Any further questions for Vince? Yes, go ahead.
This is Lee. If I could follow up on that question. What does staff think a reasonable percentage of the emerging market fund in China should be, especially given the sovereign risk? I know the problem is when you benchmark it, they become a dominant in the benchmark. But what's an appropriate level of risk with the sovereignty?
Sure. Yeah. When it comes to broad indices, particular things that like emerging countries that are in it. And this is just personally, Lee. I hate to see any one country larger than about 20% or so, within a benchmark. Now that said, the U.S. is probably 50% of the global benchmarks. Not a lot we can do about that. But you start getting down to some of these smaller benchmarks when we start seeing something bigger than about 20% or so, it really does start dominating the activity in the index. China will be bigger than that. So we're really keeping our eye on it and monitoring our exposure there.
Thank you.
Any further questions? I know I don't want to call it tea leaves, but predicting the future is difficult. And I think that at the investment committee meeting, we covered this in fairly significant detail, and we're comfortable with these conclusions. Any further questions for Vince about this plan? According to my count, there are now still should be 7 of us. Just double checking. Debbie, have you joined us?
Harold, we have 8, and Debbie has joined the call.
Okay, good. Thank you very much. I'm glad that we lost Mike and gained Debbie. I'll move this forward. Based on the recommendation of the Council Investment Committee, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve the New Mexico SIC 2022 Annual Investment Plan as reviewed, discussed, and memorialized by the Council today. May I have a second?
Second, Nick.
Okay, we've got a second from Nick, a motion and a second. Any further discussion? Would you please call the roll, Andy?
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Mr. Lavender?
Yes.
Mr. Rawson?
Yes.
Mr. Jennings?
Yes.
Mr. Kayas?
Yes.
Ms. Allen?
Yes.
Mr. Bingaman?
Yes.
Motion carries 8-0.
Thank you very much. We can move on. I have a suggestion based partly on Tim's question. If you look down under item 3, there are 2 votes there. And while we know we have a quorum, plus there's a recommendation from the committee, if it's okay, if I can have, if anyone disagrees, please let me know now. What I'd like to do is move 3, B, and C, and D forward so that we can vote on those voting matters now. Is there any disagreement with that?
I agree.
Hearing none, thank you. Hearing none, let's move on to 3B, real estate structure study. Senor Chapman. Paul, do we have you? Are we still connected?
Yes.
Oh, I'm sorry. Okay. That old mute button, huh?
Well, you surprised me, is what happened.
Sorry about that.
Okay. Thank you very much, Chairman Lavender. Every 3 years, staff prepares a structure study, and the structure study is essentially our roadmap for where we want to take our portfolio. Essentially, we're setting out actions and strategies that we believe will help us outperform our benchmark. The 2021 structure study starts on page 249 of the revised PDF that the members received. I want to start off by advising you that the structure study is a staff-prepared document, although part of the process involves a review by Townsend. So what you see in the structure study does not necessarily reflect Townsend views, but in general, you'll find that staff and Townsend's views on the investment strategy are pretty well aligned, and Townsend can speak to this later on when we get to the Q&A section. The key elements, as we see it, to the structure study are 1, to review the benchmark, make sure it's still applicable, to establish a medium-term investment strategy, and to set out the planned investment pacing for the 3-year plan period. But before jumping into that, I do want to make some general comments about the state of the real estate markets and specifically the impact of COVID on various sectors. We do live in interesting times, and you may recall from the June IC meeting that June 2020 was a pretty rough year for the real estate sector. Our benchmark Odyssey only produced a 1-year net return of 0.3%. Most of the damage was done in the first 2 quarters of the year of 2020, as valuers attempted to reflect the impact of the COVID pandemic in the face of very little transaction data. However, the 3rd quarter of 2020 brought positive news on vaccine trials, and then in the 4th quarter, 2 vaccines were approved on an emergency basis for the U.S. This news, combined with unprecedented fiscal and monetary stimulus, has led to spectacular GDP growth in the first half of 2021. Now, we use a research group called Green Street, and they're a respected source of private and public real estate research. They estimate that commercial real estate values fell by 11% in aggregate by the end of Q2 2020, so just over a year ago. But they've recovered all of that loss, again, in aggregate, and they now sit about 1% above pre-COVID valuations. But these figures hide wide discrepancies between various real estate sectors. Meanwhile, malls, office, and lodging are still well below pre-COVID valuations. And I'll get into more of these sectors in a little bit. But on page 250 on the real estate benchmark, our real estate benchmark is the National Council of Real Estate Fiduciaries Open-Ended Diversified Core Equity benchmark. We call it Odyssey. Odyssey is comprised of 27 open-ended funds owning valued at $264 billion. We are not making any, we are not recommending any changes to our real estate performance benchmark, as it continues to be the most widely used benchmark for U.S. institutional investors in private. Just the notion of moving the benchmark to Odyssey plus something, plus 50 or plus 100, but since our current portfolio is still 66% core, it seems appropriate to leave the Odyssey as the benchmark until we get closer to a balance. I want to point out a reporting change in the RBK quarterly and monthly reports, where they've reported a NCREIF Townsend weighted index. However, this index is no longer published broadly. The index remains available to Townsend and their clients for the purpose of performance comparisons. However, given it's no longer a published index and not part of the NMSIC Real Estate Portfolio Investment Policy Statement, this index will be eliminated from the RBK quarterly and monthly report. And if there's questions on that, I know Steph can tackle those later in this segment. So now turning to the real estate investment plan, which really starts on page 256 of the revised PDF of today's meeting materials. And it starts with the discussion of expected. Fundamentally, the goal of the investment plan is to put us on a path to continue to outperform the benchmark. The main elements of the plan are, one, to target over-allocation to industrial and alternative subsectors, and under-allocate to retail and office. And you heard about our redemption request earlier in this meeting, and that really stressed the point that we are trying to downplay our exposure, continue to downplay our exposure to office and retail. Page 256 shows how Green Street expects each of the sectors to perform in the long term. And you'll see that what we call the alternative sectors are generally at the top of this graphic and are expected to have the strongest go-forward returns. We are going to accordingly increase alternative allocation to a range of 15 to 20% from the current level of approximately 9.6%. We're also considering the notion of building out this alternative exposure via a REIT completion strategy. There are concerns here with adding volatility, but it does allow for immediate deployment. Nothing will be done here without further approval of the investment committees, but basically there are a number of REITs out there that are that specialize in either one particular sector of the alternative space or in multiple sectors, and it's a very easy way for us to just simply jump in and get immediate alternative exposure. Of course, the other approach, which we'll continue to use, is to invest with managers where we think the fund strategy is to focus on alternative sectors and to downplay the sectors that we are trying to stay underweight to, office and retail. We also plan to pivot into higher risk, higher return investment strategies. Ultimately, we want to get, from where we are now at 66% core, 34% non-core, to a 50 to 55% allocation to core and 45 to 50% allocation to non-core. We do want to modestly expand geographic diversification, and we want to continue to enhance our process for identifying general partners and strategies. Here we note that over a 20-year plus time frame, there's an average spread of 1,000 basis points in performance between the 25th percentile, that is the bottom of the top quartile, and the 75th percentile, which is the top of the bottom quartile. We also want to reduce manager fees by pursuing co-investment opportunities. Many of the members of the investment council will recall that we've previously brought forward co-investment opportunities, but it's been through our real return portfolio. We haven't really seen very much co-investment going on in our real estate strategies, but we will continue to look for those because they do produce an opportunity to reduce fees. With regard to pacing, we are estimating pacing at $300 to $350 million a year. This includes $50 million a year in core redemption activity as we redirect from our core portfolio into our core plus or our value add and opportunistic strategies. Pacing is reviewed on an annual basis. Pacing is shown in the write-up, and the graphs indicate that we should indicate our 12% target by year end 22 and be in the 50 to 55% core range in the 2024 to 2025 timeframe. Before opening the structure study to questions, there's a couple of minor changes that need to be tightened up in the investment policy statement. Clay will cover this, and our memo summarizing the requested changes is on page 277 of today's materials. So with that, I will turn it over to Clay, and then from Clay, we will go to questions on the 2021 real estate structure study. Clay?
Thanks, Paul. Yeah, and I'll just, as Paul alluded to, I'm just going to go ahead and cover the memo. There is a red line of the actual IPS directly below the memo in your materials if you have any, if you really want to dig in or have any specific questions. The changes we're making are pretty simple. Really just some kind of an update. We're expanding the list of the funds. Previously, it just kind of alluded to the land grant and severance tax fund. We also have real estate now in the early childhood education trust, the tax stabilization, tobacco settlement, rural library fund, water trust fund, and then certain external clients have also elected to opt into the real estate pool. And so that's exciting, and they do so on kind of an ever-going basis over the years, and so listing them just out as external client funds. Hotels are no longer tracked by Odyssey as a primary fund type. Our previous allocation ranges were Odyssey plus or minus 15% relative to the NCREIF Odyssey, which is the index that we use for tracking of real estate. So as such, hotels have been removed. And then Paul's note in the structure study of how we want to move up our allocation to alternative property type ranges. We also, instead of having Odyssey plus or minus 15%, Odyssey currently sits at about 4.5%. There's some current changes going on within Odyssey and how they are directed to allocate or assign those property types that may push that number up to 5-ish, 5.5%, 6%. But we would like to just change that to 0 to 30% just to make sure we have flexible room to get up to our 15 to 20% target. Whereas if we went to 21 or 22 for some reason, we weren't, breaking policy. So just changing that to 0 to 30% for the alternative property type. As you would have seen in the real estate structure study presentation, this is still well below what you would see in the REIT universe, where alternative property types actually take up about half of the actual universe. And so we're 0 to 30, and 30 at the top line would actually kind of fit right below, or excuse me, right in the middle of what you would see between the Odyssey and the REIT universe. And then there was a portion in the IPS which basically said, hey, here is the role of the council and of the investment committee. And it was very duplicative with what you saw of the overreaching investment policy statements that Vince and RBK bring forward, every couple of years. And so just in case changes are made to that in the future, and to make sure that our IPS and the overreaching IPS square with one another, and we just decided to default to that of the broader and overreaching investment policy statements that kind of governs the council and committee's roles. Again, that's just to make sure that the two aren't in conflict, as they often get done at different times, and obviously we would want to defer to the the one that overreaches and oversees our investment policy statements at the real estate only level. So those are the changes, and I'm happy to take any questions.
Does the committee have any questions for Paul or for Clay, and about these changes, which the investment committee felt, after reviewing this extensively, felt that this made great sense? Are there any questions?
Harold, this is Lee. I got one quick one.
Okay, Lee.
And I might have missed it, Paul, but what are we expecting the return going forward out of this portion of the portfolio?
Sorry, Member Ross. So when you say this portion of the portfolio, you're talking about the real estate portfolio in general?
Correct.
Yeah. So it's really hard to call. Odyssey generated a 0.3% net return in 2020. Early numbers are in for 2021, the first couple of quarters, and it's been very strong. Seth may recall the numbers exactly, but I think many of our managers between the two quarters are already up 6 to 8%. I think expectations are really Odyssey will generate 5.5 to 6% net returns probably in the 3 years of the structure study. But I'll let Seth weigh in with Townsend's view on that.
So Odyssey in the second quarter. So to Paul's point, we had a bit of a bounce back when we look at the Odyssey performance here in this part in the first half of the year, and we'll talk about performance in just a moment later on in the agenda. But we saw 4% gross return, quarterly return from Odyssey in the quarter ending June 30th. So that's significantly higher than we've seen historically. It's basically the highest we've seen since I believe 2011 or 12. So going on about 8-10 years. And going forward, we do anticipate Odyssey to moderate in the 6 to 8% range. Our portfolio, given 50% roughly to non-core, is anticipated and projected to outperform that. To put an exact number on it, it's quite difficult these days. But I'd say about somewhere in the 100 to 200 basis points above the Odyssey would be appropriate for the portfolio as it stands today.
Good, thank you.
Any further questions? Hearing none, based on the recommendation of the Council Investment Committee, Real Estate Advisor of the Townsend Group, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve the updated real estate structure study as reviewed, discussed, and memorialized by the Council today. May I have a second?
This is Lee. I'll second.
Thanks, Lee. Thank you. Moved and seconded. Andy, would you call the roll, please?
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Lavender?
Yes.
Mr. Rawson.
Yes.
Mr. Jennings.
Yes.
Mr. Taya.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Motion carries 8-0.
Thank you very much. Moving on to 3C, which also asks for a vote, and this is the ESG policy that Tim asked about earlier. I think based on how it's listed, Steve, do you want to begin this?
I'd be happy to, Harold. As you all know, at the last council meeting, RVK made a fairly in-depth presentation regarding ESG, and I think that informed a lot of the council's questions. The ESG policy is contained in today's materials, and at the last council meeting, Mr. Rawson asked for our legal staff to provide a memo regarding how the ESG policy relates to members' fiduciary duties. You also have a copy of Bruce Brown's August 2 memo to the council on that topic. And Harold, I honestly have nothing else to add, but if there is discussion, we will be happy to respond to any questions council may have.
Lee, has the information provided satisfied your questions?
Yeah, it satisfied my question, but it doesn't change my opinion.
Okay.
Thank you. I do appreciate Bruce's work on it.
Okay. Does the rest of the council, anyone have any questions or issues or things you'd like to discuss about this policy? We've spent a fair amount of time on this, and we did cover it fairly well, and RVK covered it very well at the last meeting. So, hearing no further questions, based on the recommendation of the Council Investment Committee, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve the environmental, social, and governance policy as reviewed, discussed, and memorialized by the Council today. Do I have a second?
Second.
Okay, I think I heard Kathy, seconded by Kathy. It's been moved and seconded. Any further discussion about this policy? And Andy, would you please call the roll?
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
No.
Mr. Jennings.
No.
Mr. Taya.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Motion carries 6-2.
Thank you very much. I appreciate that. I think I have one other item to cover under Section 3, and that is that I think all of you know Gene was terrific as an advisor to the investment committee, and it's felt that another strong voice could be really helpful. After reviewing the matters and discussing it, the investment committee would like to appoint John Ulrich as an advisor to the investment committee. This doesn't really require a vote, and I'm simply looking for a sense that the council is okay with this. Once again, the members are Nick and Mike and me, and John would serve as an advisor. Are there any questions or issues about this request by the council, by the committee?
This is Kathy, another nonprofit board with him. He's an excellent in the financial investments, and it fits with us having more people that have through financial investment experience to help us with the committee. So I strongly support the idea. And John.
Thank you, Kathy. Anyone else?
This is Lee, Harold.
Yeah, Lee.
What I thought I heard you say, and I'm glad to have him on board. I'm just trying to think of the proper procedure. I thought I heard you say that the investment the investment committee wants to appoint him. And I think that any member of a committee should be appointed by the council. So I would prefer that it comes from the council as a whole rather than having individual committees going out doing their own thing.
Okay, I may have misspoken. What I had wanted was to get a sense of the council's approval of the committee's request to add him.
I think that's fine. I just think it needs to be sure that the council is the one that's taking the action, not committees. And I think the committee making a recommendation is appropriate.
Absolutely, and that's exactly where we were. When we discussed this, we didn't think it needed a formal vote, but we simply the sense of the council would be that they would approve this recommendation. I don't have a problem with taking a vote either, if you would be more comfortable doing that.
Well, I would sense that there's been this discussion as to whether or not a advisory member actually has a vote. And if an advisory member doesn't have a vote, then why do they want to waste their time, so to speak? So to me, I think that the council should take a vote on it if there's the possibility that we're going to have advisors have a vote.
Okay.
And if we're not, then I don't think it makes a difference.
Okay. So, some time ago, the council approved that the advisors do in fact have a vote. And so
then I would suggest that this should be a voting by the council.
Okay.
Chair Lavender, this is Evan.
Yes, I can, Evan. Thank you.
Members of the council, this is Evan Land. I'm sorry to intrude. As an open meetings matter, this was not noticed as a voting matter. So if the council wants to vote officially for members of committees, I would ask that you defer this till next month. As a general matter, committee members they participate in the committees, but committees are advisory only. So they are not binding the matter, the committees, they're not binding the council in any way. So I don't think a vote is required in terms of participation, but that's up to you what you would like to do. But if you want to formally vote, please wait till next month as an opening meetings agenda notice matter.
Lee, what are your thoughts, please?
Council committee can prevent an item from being moved forward, then they do have an impact on what the council actually has an opportunity to vote on. So I would suggest that we communicate to John that we'd love to have him on board, but we'll take a formal action at the next meeting. That would be my preference. Not the end of the world, but I think it's a better procedure.
Okay, having heard what Evan has said and your opinion, I'm comfortable with that. I think we'll let John know that it'll come to a vote in September. But I think that at this point we will, and I would like to request that be included as a voting matter, and then in the September meeting. Is the rest of the council comfortable with this?
Jim is.
Yeah.
Okay. Okay. Thanks, Debbie. Let's move forward then. We will communicate to John that we would love to have him, and that we'll bring it up for a vote in September. Okay. I think that moves us back into. We can go back now to number 2. John, how long are you going to be able to be with us?
I think I've got about 45 minutes.
Okay, that's great. I know that you had indicated before that you have to catch a flight. Having said that, let's go ahead and go back to the SIO briefing, and Steve, 2A.
Thank you, Harold. If you would please refer to the SIO briefing. Current NAV, net asset value, $34,549,266,000. Total distributions over the last 12 months have been $1,070,449,000. West Texas Intermediate Oil, as of August 21, the most current date we were able to find, $68.56, and the New Mexico price, $66.46. Just a couple of dollars behind. Rig count. As of August 20th last year, there were 47 operating rigs in New Mexico. As of August 21st of this year, that number is 78 operating rigs. And I want to thank Don Iglesias at the LFC for providing us with this information. Don is always very helpful. Another item came out of the LFC in their newsletter over the last couple of days that I think you'll find interesting. What it said: natural gas July and the first week of August, because power generation fuel has been in high demand. Prices remain above $4 per MCF through March of 22. And if they hold at fiscal year 22, compared with the February consensus forecast of $2.70 per MCF, and that is a potential additional $121 million flowing to the general fund. It's nice to see natural gas performing well again. It's been a while. Moving down now to item 6 on the SIO briefing. We have now covered the ESG policy and the related memo. Thank you, Council, for approving that policy. Item D, you'll see that we're still looking for a financial analyst that is someone to work in the public equity area with Starla, an IT professional to work with David. Pardon me, I'm going backwards here. Starla's public equity analyst, someone to work with David in IT, and a financial analyst for Brent in the accounting area. 3 people we're still looking for. It's really hard sourcing people right now. I think we have a good lead on an IT person. We're having a hard time finding someone for accounting, and we'll be interviewing another candidate for the public equity role in the next 3 or 4 days. One of the problems we're having in hiring investment professionals is our inability to have compensation flexibility. We're trying to deal with that as best we can. As all of you know, we've been working remotely as